9:30
Yes, ma'am.
now. We will call the meeting to order. I think on the screen in front of you, you will see an agenda, which I think was also mailed out to everyone previously. Would there happen to be a motion to adopt the proposed agenda as presented?
So moved.
And a second?
Second.
All in favor?
Aye.
Ayes have it. And I think also you should receive on Watchdocs the February minutes, and those have been revised, and you should have gotten the revised ones they were posted yesterday with some additional detail requested by Mr. Condon. Do we have a motion to approve the minutes as they were presented yesterday and as they are on the board, or on the screen?
So moved.
And a second?
Second.
All in favor?
Aye.
Aye. Ayes have it. Okay, second order of business, Chair's report. I think first we have the retiree representative nomination. I think, I know, Dr. Wilder's term is, and you may all know, or you may not realize that 5 years have passed that quickly, but his term is actually expiring at the end of this fiscal year. And under the current law, he is eligible to serve another term. This one will be 4 years if he is so willing. I would like, Mike, Mr. Hitchcock, if you don't mind, you can kind of go through the governance policies regarding contacting the retiree groups
Sure.
for input.
Yes, ma'am. Madam Chair, under our governance policy, we can basically at this meeting, given that this is the meeting before we would elect a retiree representative before the representative's term would expire, we under the governance policy are required to solicit the input of the retiree stakeholder groups, which I will be doing subsequent to this meeting. We prepared a letter to send out to both of those groups, both the State Retirees Association and then the State Employee Association also has a retiree group. So I'll be sending a letter to them indicating that we are soliciting their input for the retiree representative. However, I believe it's my understanding that Dr. Wilder is willing to continue to serve and would like to seek another term. I believe it is in order for us to go, or for the commission to go ahead and nominate him at this point. We can certainly take into consideration any other nominations that we may receive during the ensuing period between this meeting and the meeting in June. But I think it is, we can go ahead and, if the commission is so chooses, can go ahead and nominate him for another term. That nomination would just remain open until the next meeting. And if we were to receive any names from our stakeholder groups, I would forward those names to the commission, and then the commission can decide whether or not they would want to interview those potential candidates. But I believe it's okay to go ahead and nominate him today. And I will, in the letter that I will send to the retiree groups, I'll ask that they provide any suggestions by April the 26th, which is 2 weeks from today. So,
Dr. Wilder, I guess this is true that you are willing to serve again.
Yes, I am.
Being that, and thank you for the explanation, would there be a motion to nominate Dr. Ron Wilder to serve as the retiree representative to the commission from July 1st, 2018 through June 30th, 2022, or until a successor is appointed and qualified pursuant to state law?
It would be my privilege to make that nomination.
Thank you very much, Reynolds. Do we have a second?
I'll second.
Okay.
that's all we would need to do.
That's all we need to do?
Right.
Okay. All right, second order of business is that we are at that time again after 2 years where we need nominations for the chair and the vice chair position. And please do not all jump and volunteer at once. But for the chair, it has been traditional that the vice chair steps into the chair position or becomes nominated for that. That's not necessary, but having worked with Dr. Wilder for 2 years very closely now and knowing how adept he is and how skillful he is, I would like to go ahead and nominate Dr. Wilder to the position of chair for the term commencing on July 1st and ending on June 30th, 2020. 2022. Or no, 2020, actually, sorry, it's a 2-year, yes.
Yeah, it's not a 4-year sentence.
No, it's,
Just a 2. He gets 2 years off for good behavior.
so that, I guess that might be a motion, so
Okay,
if there was.
I'll second the motion.
Okay,
And then that, again, that's all you would need to
And
do.
that's all.
Yeah, because that'll remain open until,
Yeah.
you'll actually bring that to a close in June.
yes,
Yes, ma'am.
okay.
Do we have the ability to move that the nomination be closed, or are we required to keep them open until the next meeting?
Reynolds, I think I believe on the governance policy, we'd have to keep it open until the next meeting, because, there is a need for the heated campaign season in between now and the June meeting, but, and also, I think, given that especially with this, given that Dr. Wilder's being renominated for the chair, then, the kind of step 1, step 2 and given that nomination has to remain open, I think this one, it would also follow that this one would remain open as well, so.
Okay, well, that leads us to the position of vice chair. So I think we are looking for nominations for vice chair, which would, again, be a 2-year term commencing on July 1st.
I would like to nominate Rebecca Gunlogson for vice chair, recognizing that this may seem a little unusual to move from chair to vice chair, but I think given all the circumstances, it makes good sense for us to do that.
I'll second if she's willing.
Well, I thank you for the vote of confidence.
Overwhelming sense of confidence.
It
in your
is,
ability.
I feel, yeah. But I will note that this is open until the June meeting. If there is anybody who feels that they would like to nominate somebody else, that is certainly open. No, but it is, has been an honor and a privilege to work in this capacity and to work with Ron. And if that is so the will of the commission, it would be an honor to continue to do that for another 2 years. In a slightly different role, but still working with Ron. Okay, that's all we need.
That's all we need.
Okay.
Yes, ma'am.
Let's see, the next on the agenda is the Audit and ERM Committee report. Mr. Gillespie.
All right, so the committee met on March 22nd. The first order, we reviewed the committee charter and have some proposed updates, which I believe were I know on the website, so everyone's had access to them. Don't make sure everybody saw it, but the revisions to the charter reflect changes to commission's policies and operations, and then one change in the posted version is to move the committee's evaluation to be completed in conjunction with the commission's annual evaluation. And the primary changes really reflect kind of the some of the titles. I mean, some of them are just kind of technical in nature, as well as more of an outsourced model as it relates to some of the audit functions. So hopefully everyone's had a change to that. So the committee is, I guess it's because it's already been voted on, it comes up as a active motion.
Right, yeah,
Right.
it doesn't need a second. Yeah.
Right, doesn't need a second. So the committee recommends that the commission amend the charter and adopt the proposed revisions to the charter as presented, and authorize staff to make the technical revisions to the charter and other RSIC policy documents to reflect this decision. But
So, okay,
Right,
so
so-
we need no second. That is an active motion from the committee. So I think we would, if there's no discussion, we would go ahead and vote on it. All in favor?
Aye.
Any opposed? Okay.
All right, the next thing, we, fiduciary performance audit, that's now part of the statute, isn't it?
It was.
Yeah.
Yeah,
Yeah.
it has, it's once every 4 years.
Every 4 years. So, so the Office of State Auditors selected Funston. They'd been doing the vendor search for that to complete the next fiduciary audit for RSIC. And preliminary work on that's already begun internally, getting ready for that, which we expect to kick off in earnest in conjunction with the fiscal year. Is that?
They will be on, we're providing with a great deal of documentation, and I believe at the beginning of May. They'll be
Right.
on site doing interviews for 3 days, I believe, in the week after the commission meeting in June. And then we'll probably have some follow-ups. So they will, I think that they'll obviously be here and they'll interview staff, but they'll be contacting you all too to schedule interviews with the commissioners as well, probably during that time period. So if you want to do it here, that's certainly fine while they're here on the ground. But if not, I mean, we can facilitate those interviews as well.
Okay. We also discussed the GIPS vendor selection. This is kind of a newer thing in pension plans. We know California has recently, the California plans brought it into GIPS reporting standards. So the committee issued an RFP for GIPS compliance verification, and the process for vendor selection is ongoing. So we'll provide additional information about that. Other than that, anything else you'd like to add? Yep. Any questions? Comments? If not, that's the report from the audit committee.
Okay, thank you. Next on the agenda, we have the report from the Human Resources and Compensation Committee. Dr. Wilder.
Thank you. The committee met in March, talked about a number of things. One was the change to the committee charter relating to our self-evaluation, as well as adding an item to the charter that the committee consult with the CEO on, that we consult with the chairman on the CEO's evaluation and also the CEO's compensation. The next thing we discussed was changes to the compensation policy. These are mostly formal changes made in response to the new state pension law setting up the CEO in his current position. And we also discussed the compensation policy. That's the one I just talked about, isn't it? On the compensation policy, we also discussed cost of living adjustments to the salary ranges that we received from the consultant. We obtained an overview of the new CEO and staff evaluation process. And finally, we have the opportunity at this time to obtain a new compensation consultant. After discussing with staff, the committee decided to postpone that for a year, and in the meantime, just rely on the compensation consultant for adjustments based on cost of living changes to staff salaries around the nation. Let's see. Mike, would you proceed with the motions
Yes, sir.
related to those developments in the committee?
Yes, sir. Thank you, Dr. Wilder. The first would be, these are coming from the commission, coming from the committee, so they would, again, not need a second, but that the commission approves the recommendations of the Human Resources and Compensation Committee, that the commission amend the charter of the Human Resources and Compensation Committee as presented, adopts the revisions to the charter as presented, and authorizes staff to make technical revisions to the charter and other RSIC policy documents to reflect this commission decision.
Okay, so the motion coming out of committee then, is there any discussion on this?
I would like to discuss it a little bit. I was looking
Sure.
at, there's one thing, and this is kind of a math question, because, it's a pretty complicated document when it gets into the salary bands and ranges and then the merit. And it looked like someone who's exceeding expectations could, on their individual merit scale, earn up to 8.5%. But then the overall policy for the pool is 6. So theoretically, you could have a situation where everybody's fallen into a bracket that exceeds the totality of the pool. I know that would be a rare occurrence, but it just didn't.
Yeah, and I can address that.
Yeah.
We would certainly hope that we would be in a position where everyone had exceeded expectations. And in that, and you do have, the way that we have kind of implemented that policy, and last year was the first time that we had a pool to award the merit-based compensation increases. In essence, what we do is we create what I refer to as an order of merit list. So we take on both the operations side and the investment side, we take all of the EPMS scores, and the executive team kind of does an overview of those to make sure that there's that they make sense. We try to mitigate any potential, given that where one grader might be a little bit more strict. So we try to make sure that the order makes sense. We break it out into, how we stratify it based on the budget that is created from the amount that we have to work with. So whatever the raises are, they have to stay within that, you have to stay within that budget. The table that is in the compensation policy is an example of how that may, but if there's if we hit all three benchmarks, and there's a 6% pool, it has to stay within that. You have to stay within that pool, so you've got to adjust it accordingly. So, and so we do that based kind of on how the staff performs relative to the other people within their groups. Hopefully that makes sense.
And just a point of clarification, I think that I'm accurate on this. When the General Assembly doesn't have a pay increase for state employees in the budget this year, but the way I read the policy, that if the General Assembly does have a pay increase for employees, then our employees would get that general increase as well as the increase under the compensation policy.
The way that the policy is set now, yes, that we adjust the bands based on that we do award whatever that increase is, whatever the across the board increase is, they do get that. Yes, that's correct.
Another question, and I assume this came from the consultant, but it looked like there are 12 bands,
Yes.
and we have, 40 people?
Right.
It seems like a lot of bands for 40 people.
It's the one thing that we realized that kind of in working with them, we realized that we're a smaller organization, so that's why as you kind of go up, you see the ranges fan out, because we would expect for people to, at some point you're going to get to a spot where there's not really any more room to grow. So it gives us the ability to if there's a position where somebody's become so senior that we might want to move them up the next rung of the ladder, but then we can potentially go back and have that position reclassified. So it just gives us a little bit more flexibility. But in order for me to reclass a position from one rung to the other, I've got to get the approval of the HRC committee. So there's transparency in that regard. And the length of the bands give us enough runway to, for people to make it attractive for people to stay for a significant period of time, even if they're not necessarily position-wise moving up. So, but your point's well taken. It's a lot of rungs on the ladder. So.
Any other discussion? Okay, if not, we'll go ahead and vote on the motion. All in favor? Aye. Any opposed? Okay.
And then we have the
Second motion.
yes, ma'am. The second motion would be the commission approves the recommendations of the Human Resources and Compensation Committee that the commission amend the compensation policy, adopts the approved revisions to the compensation policy as presented, and authorizes staff to make technical revisions to the compensation policy and other RSIC policy documents to reflect this commission decision.
Okay, is there any discussion on this motion? If not, all in favor? Aye. Any opposed?
Aye.
Okay, ayes have it.
Okay.
Next on our agenda is the CEO's report. Mr. Hitchcock.
Thank you, Madam Chair. It's my pleasure to recognize, we've already recommended him, but to recognize a new staff member, Kevin Reinhardt, if you'd stand up so we can take a look at you. Kevin is part of our performance, has joined our performance team. He comes to us from the Attorney General's office. He's worked for a financial advisory firm, bringing with him a unique combination of investment knowledge and forensic accounting skills. He's originally from Florence, and he currently lives in Lexington. So, thank you,
Welcome.
welcome, Kevin. Thank you very much. And that is the extent of my report, Madam Chair.
Well, that was very short.
Yes.
Okay. Then next, I think we have the investment performance report. Mr. Byrd.
Thank you, Madam Chair. David King is going to walk us through performance, but really briefly, through 8 months, our return, as you will see, is slightly north of 8%. This puts us slightly ahead of the median pension fund for the fiscal year to date. February was a rough month. I'm sure that goes without saying. And even though we were down over 2%, as you probably expect, that was a source of outperformance for us against the peer group, owing to our lower exposure to equity than that cohort. March was also a somewhat challenging month. While we don't have official returns, we are expecting those to be very slightly negative. So as we sit here today, we estimate our return to be in the neighborhood of 7.5% for the year. So I just wanted to share that and then get out of the way of David so that he can provide the update.
Morning. Morning. So looking at our February fiscal year-to-date performance, for the month we were down 2.17% versus a policy benchmark of about 2.14. So that brings us fiscal year-to-date to just above 8% versus a policy benchmark of 6.81. Within our policy bands, you can see that we're within our SIOP ranges and just slightly overweight in GTAA and an underweight in non-portable alpha hedge funds and mixed credit. Looking at our performance in dollar terms, you can see throughout the fiscal year we've paid out $825 million of net benefit payments. And our investment performance has added $2.4 billion to the trust, bringing us to an ending value of $31.7 billion.
Can we go back one more slide?
Sure.
Is there, because of the increased volatility here in 2018 and such, or is there any thought or movement of making some strategic changes within those bands, the allowable bands?
Well, we are going to, in just a few moments, talk about those bands. Can we table that?
Sure.
For just a moment, so
Okay.
until Frank leads us in that discussion? I don't want to have that twice necessarily and
That is perfectly fine.
run Frank off the road here, so.
Okay.
But very good question.
So looking at our market value through time, you can see a slight pullback in February, but we're still very much on an upward sloping trend. And just from our 2007 peak to trough, it was negative $11.1 billion. And then the peak to current is $2.2 billion. So those assets have recovered since the global financial crisis very well.
Can I ask just one little update on that chart? Because when you pull it up on a normal PC, it's really, that little box becomes kind of small. And kind of your natural reaction when you see the drawdown is you're thinking in percentages, and then you see the little B, right? You know, maybe a BIL and maybe the percentage too, right?
Sure.
Would make it a little bit more intuitive, because that was like, when I pulled it up on my normal screen, unless I expanded it, that was a very hard little box to
Noted.
see, right?
Absolutely.
So if we could just add that and clarify that, that would help.
We will do that.
All right.
And this last chart shows our absolute return on the x-axis and our excess return on the y-axis. So you can see the majority of our asset classes are in that upper right quadrant, with the exception of public real estate showing a negative absolute return of 6.26, but a positive excess return of 3% over the benchmark, and core fixed income being about negative 1% absolute return. On the right-hand side, you can see our portable alpha hedge funds are still performing very strongly throughout the fiscal year, and our public equity is also performing very strong.
Could I pause you there for just a second? I want to briefly just make sure everyone has clarity. The bubble that is extended out to the left is it's called public real estate exposure. That's the REIT portfolio. That has been a victim of the rising rate environment. Our manager has done a very good job against that, but still, nevertheless, the return has still been negative.
Lastly, just looking at our percentile rankings, you can see our rolling fiscal year-to-date percentile ranking is just above the median in the 46th percentile. Our rolling one-year percentile ranking is the 72nd percentile. And at that, I'll pause for any questions.
If you don't mind, David, go back to the very first slide.
Sure.
I think for me, it would be helpful while we include the comparison to our policy on that slide. So fiscal year to date, the policy is 6.81. It would be helpful to me for that slide to also include the median peer return, because I think based on the information that I think you guys just sent out, I think the peer fiscal year to date median return is like 8.12%. So it would help me to see both our policy comparison as well as peer performance comparison.
Okay.
Well, we're above the median for the fiscal year to date. Yeah.
I think what we got yesterday showed the median at
We're
8.1.
in the 46th percentile for the fiscal year to date.
Yeah,
So-
8.12, but you're gonna have the gross versus net
Yeah,
differential.
right. Yeah, like what you see here for our fiscal year to date return, it's always going to be a little bit lower than what you see in the BNY Mellon universe, because what we get from BNY Mellon is not net of invoice fees. So, and that holds true for everybody else in that universe as well. So we don't necessarily know what the look-through impact of that would be to as far as other pension funds go. So, they could have more or less of that return. It's net of fees taken out of the NAV, but it's not net of fees, net of invoice fees, so we don't know necessarily apples to apples how much of that return that is shown on the BNY Mellon universe is gross versus net. So what you're seeing here is net of NAV and net of, so, I mean, you might have
So that peer return might be slightly different here than
Correct.
it is on BNY, but I just still think it would be helpful for
Well, I
us to see
think,
the peer.
but in doing that, it's not a true comparison, though, is what I'm saying. So I don't necessarily think that is as, I think certainly including I think it might be more helpful to include the BNY Mellon slide in this, so that we see that. But if we're gonna make the comparison, I would wanna make it apples to apples, not apples to we don't know. 'Cause,
And I'm
yeah.
comfortable making it apples to apples. I just would like to have the peer comparison.
Sure, but then, like I said, but we don't, the median pension fund return that we get from BNY Mellon, that is not apples to that. So, I mean, if we wanted to include our gross, like, if we wanted to include.
Well, that info's on the other charts that are.
Yeah,
in the book.
the last slide
Right, I
had,
mean, if you keep
well, it was a
going, the
rolling
information
1 year,
you'll get
but I
on
mean,
some of the other charts.
the last slide was rolling 1 year comparison.
Yes.
It's both
Right.
here and there's the verse universe
Yeah, so
charts,
so we
right?
could just add the universe slide.
Yeah.
Yeah, I mean, I think it's a-
Slide that we get in
yeah.
our flash.
I think so.
Yeah, because that way it's just better. I think that's just a more apples to apples comparison. And it's, for us, it's not necessarily significant, but I wouldn't want us to put two flavors of numbers on the same chart and say that that's a comparison, because it's not necessarily. So, but I'm perfectly comfortable with us including the BNY Mellon slide on
Okay.
it. So,
Do we want the one that's $1 billion or higher, or $5 billion? or
we've been
higher?
using the 5 billion because that's a
Okay.
little bit bigger, that's usually a little bit bigger hurdle.
Okay.
Because that usually performs better than the
Okay.
1 billion. So, we're usually slightly better against the 1 billion than we are against the 5 billion, but we've chosen to use the 5 billion because
Okay.
it's a higher hurdle.
Okay,
so.
excellent.
Yeah. And just to give a little bit of flavor about the BNY Mellon universe, I've kind of anecdotally looked at some other pension funds that are, pension funds that are well-funded, that have decent returns. And when I overlaid their returns into our universe, that's a decently tough universe that we're in from a peer perspective. So I think if we are ahead of the median in the BNY Mellon universe, then we are doing well comparatively, because there's several pension funds that are pensions that are well-funded that would find themselves well behind the median, even in the bottom quartile, as I kind of look around the universe. And the other thing is, we don't necessarily know who's in it, too. So we don't know who's in the other 37 pension funds. We don't necessarily know who they are. It's just, they're funds that are custodied at the Bank of New York. But it is we are comparing ourselves against a competitive universe.
Can I ask, can I throw maybe another variable, and I doubt it can be cut this way, but I think it's important. It goes a little bit to Bill's question that is in the report. It goes into the way our policy benchmark shows up when looked in the universe rankings. It goes straight to our discussion about asset allocation, right? And it comes out in the minutes saying that the hurdle also informs our asset allocation. We're 7.25. That's not a uniform assumption across the universe. So to the extent that people are trying to hit a number, their asset allocations have more or less equity exposure, because some people are still at 7.5, some are, still at 8, some are maybe 6 and change. It seems like even that peer universe needs to be, all right, who's actually shooting for the same target and has the same size? Right?
And
Because we're not all aiming at the same thing to begin with, right?
That's a good point. That's a very good point.
if you could overlay, if there was a way for us to overlay the
Like 5 billion that has a 7.25
Right.
hurdle, right?
Yeah. And one of the things that we're trying to work through with BNY Mellon is we're trying to get some look through kind of as to what the asset allocations are, the median asset allocations, to give us a better view of, because the number is one thing, but that doesn't inform us necessarily as to how you get there, right? So that's another, we're trying to get some better look through into how, how you get there. But you're right, if somebody's shooting for, they've still got 7.75 as their assumed rate of return, then they're going to be shooting for something that's a little bit different than what we are. So, so I think that, that is an interesting point.
If I could just add a couple things. This is something that we're looking at more intensely between now and the next meeting, because one of the things that it's in the AIP document is a look at additional forms of benchmarking that frankly will be useful to me, and I believe would be useful to the commission, to kind of look at performance some different ways, and some of these relate to the peer group, but we need to have a much better understanding of that. So we're preparing a project that's going to be a more rigorous look at understanding those issues. The other thing I would add is we are, I believe, Andrew, next week having some discussions with our custody bank about an additional service that we're going to explore accessing data they have that would hopefully feed this better understanding as well, and we'll be happy to share that if we find it valuable. So just offer that for the commissioner.
That's all I have, so thank you.
Thank you, Mr. King.
Okay, I believe now we have the consultant report, so I'll turn it over to Frank.
Morning, everyone.
Morning.
So what we have today are just a few things, so a much shorter presentation from us today than you've had from the last couple of meetings. And I'm sure all pleased to hear that. These issues are follow-up items from the last couple meetings. They are related to the asset allocation policy that you adopted at the last meeting. And the first thing we're going to talk about are target ranges, to Mr. Condon's question. When you approve the new targets to the asset allocation policy, you should in theory adopt ranges around those targets. Ranges allow you to do two things. Number one, they allow you to stay in compliance with your investment policy. So when we design the ranges, you can see, if you look at that second column of numbers, there's different width for the ranges for different asset classes. More volatile asset classes obviously are going to move around more, so we're going to tend to give those wider ranges to allow for that volatility and allow for you to stay within your investment policy, in compliance with your investment policy. The second thing ranges do is they give your staff the ability to be tactical if they are so inclined. And I'll let Jeff answer in a minute if he is so inclined. But again, the ranges might be designed in a way to give them that flexibility depending on what asset classes they want to move in or out of. So it tend to be the asset classes that are very much risk on or risk off asset classes. So equities, you count as sort of a risk on asset class. High quality bonds is a risk off asset class. Those tend to have wider ranges because it gives them that flexibility to say, okay, we're worried about pricing. We want to move into bonds or cash, for example. And these ranges are not necessarily symmetrical. What I mean by that, if you look at the equities allocation, we're saying a range of as much as 8% over, which really kind of allows for, if you're over your private equity target as well, but as much as 20% under. So this allows in, a dire circumstance, if staff says, this is global financial crisis, redux, we can take a lot of risk off the table, and that gives them the ability to be more conservative, putting it into, for example, cash and bonds. Because you already adopted the targets in February, we'd also recommend that you adopt these ranges and make them effective immediately so that staff can move forward with implementing the new targets. Questions?
I've got a question about the range for cash and short-term bonds. Less than 7, so it can go down to 0. Should we ever have cash at 0?
So
I'm just wondering if it ought to be a little higher than 0.
Honestly, a lot of pension plans do maintain technically a target of 0 for cash because they use their cash just for, we'll call sort of use a borrow economics term, frictional purposes. To be able to pay your benefits, to be able to make capital calls for your private market asset classes. And it's just that short-term cash, essentially the equivalent of your checking account is where you would normally keep cash. Giving you but we still maintain a 1% target to allow for that, to meet those needs. But obviously a much higher range on the upside in case again, staff wants to have a higher range there. The other thing I'll note is cash is your lowest returning asset class, which is why most plans try to minimize that because it's sort of a drag on your returns.
Do we have any significant differences between these ranges and our previous ranges?
There's a slightly wider band around global equity, and that's actually something that's become a little bit burdensome, which is why I would like what we adopt to become effective immediately, because we are going to begin the process of transitioning to a slightly higher equity allocation. I'd like to have the flexibility to take advantage of the current environment so that we're not just kind of having it all get done on July 1st at whatever the market is at that point. So I'd like to have a little additional flexibility, which this certainly provides. That's the major change, and it's not, I wouldn't say it's major, it's a relatively modest change, but, so I didn't mean to take the words out of your mouth.
They're wider from, now they're +8 to -20.
Yeah, and the -20, think of the -20 as kind of think conceptually pairing with the cash level being allowed to rise to 7. In the event we would find ourselves in a 2008, 2009 scenario, we may feel that there is sort of an unmanaged deleveraging happening, which would be very, very catastrophic for a lot of risky assets, and we would want to have flexibility to recognize that environment and be more risk averse in the teeth of that.
How tied to the volatility assumptions are the ranges? Any at all? Right, but because,
Yeah.
like, for example, just take equities, right? If we're at 51, right, and we have just our normal assumption of, say, 20, right, on the vol.
Yep.
One move up, we're forced to rebalance and sell and rebalance down. But to actually rebalance on the downside, if, you know, with a mean return of 8, right, to actually force a rebalance, I have to
Yeah.
have something that's 4 or 5 standard deviations out versus 1 or 2.
Yep.
Where you logically should be rebalancing some if you're a long-term
Yeah.
investor. So I just kind of wonder if those lower ranges don't need to come up a little bit or be, you know, kind of tied in with our volatility assumptions.
You mean broaden those ranges?
No,
or
tighten them up.
tighten
Like,
them
so
up?
for example, like if equities have a mean expectation of 8 with a vol of 20, right? So 2 standard would be down, you know, 40 off of 8, so down 32.
Yep.
So 32 off my base of 50 would put me around 35. Should
Yeah.
suggest the lower end of the range where I'm forced to rebalance.
If
Right.
nothing
Yeah.
else moves at the same time.
Right.
Yeah.
Versus 31, you know, versus 30 or 31.
Yeah.
I got to go yet more,
Yeah.
right?
Well, and I know that you're sensitive to this also. I think there's also a discussion around this about rebalancing protocol,
Yeah.
you know, which we've been more disciplined in that in the last couple of years, frankly, to be more aggressively oriented to rebalance. But, you know, I mean, I think it would be most likely to play out in a prolonged kind of where we're choosing not to rebalance, you know, but 1987 can happen too.
Right.
You know, so it's a fair point. I'll defer to Frank on the thought process, but
There's certainly a linkage. It's not a mathematical equation that we've put in place here for each asset class.
Yeah.
But to your point, if equities are down that much, it's a good bet that your credit's going to be down 10 or 20% as well.
Yeah.
Your real assets are going to be down. So that alone is probably not going to hit them to the bottom of their range.
Right.
I would like to never use the down 20 in equities. I'd be,
Right.
if I never need that,
Yes.
that's too soon.
Yeah.
But if you think about you're in that environment where you are doing that, those assets need to be somewhere else. So I think that's part of the, you know, the historical rationale for having some latitude. You know, in the 2009 time period, you know, we did make a meaningful move into the opportunistic credit space. So some flexibility to kind of move elsewhere in the cap structure, I think, is particularly valuable at times. But, you know, I can manage inside this comfortably. If the commission wants to kind of change it,
No, I mean,
I'll adapt to
No,
that.
well, I know it's in
So-
the AIP to look
Yeah.
at some of the rebalance and stuff, but I think ultimately your rebalancing policy ought to tie back into this, which ought to tie back into your assumptions if you're gonna have it fully internally consistent,
Yep.
right?
I wanted to ask about the measurement of the target in the ranges. Is this a point in time? Is it a rolling average? How is it measured and how frequently?
So they're usually measured as a point in time, a snapshot. You know, I believe staff is looking at this on a daily basis.
For the purpose of compliance
Yes.
with this,
Yeah.
that is month end every month.
Month in?
Month end, because during the month, you know, the way we have always done this is you need to be compliant at the end of the month. The market can take you to the point where you would need to rebalance, but since the way that you construct your benchmark return assumes you start with the target amount and you live with that until the end of the month, we've just made our compliance match that. So if equities, you know, you start out at 50% in equities are up 20% in a month, which highly improbable, you know, that would if all other asset classes were earned zero, that would take you to 60% equity. And it would create a compliance event were you not to rebalance. So we've always had the discipline of respecting the beginning allocation through the month, and then the time for rebalancing is end of the month. Because that is how you would assess performance as well.
And so on a monthly basis, you go through this process?
Yes.
Rebalance as necessary?
Yeah, well, we focus our rebalancing analysis. We start really looking at what the size of the trades is going to be kind of the last week of the month. Because we need to, especially if we're needing to rebalance in a foreign market, we need time to plan that. We actually, frankly, we begin the process of eyeballing it mid-month because some of our strategies require advance notice, so we try to be out in front of it. But it's part science, a lot art to this. I hope that's responsive. Okay.
Sorry, did we return private equity to a hard target, or is that still
We
a
did not.
soft target
Yes.
underneath equity? Okay.
And I don't want to start into a discussion of that, but if, if we would, if anyone would like to.
So effectively, the target and the ranges are not binding specifically.
The
but-
range is the more important element in those circumstances for private equity, private debt, and for the private real estate, because we have a public alternative for each of them.
Any other questions for Frank? So. We have,
I think we need to do benchmarks too.
oh,
Yeah, we'll move on to benchmarks.
Okay.
Yeah, and then we can adopt the.
okay,
have
adopt them
discussion and
together,
adopt, yeah.
okay.
All right, so the other thing that related to asset allocation, and this is a pretty intimidating page when you look at it on the surface, are recommended changes to the policy benchmark. So first, let me just explain how this page is laid out. The first column, that left-hand column, is for the asset class. The second column is what your current policy benchmark is for that asset class. The third column is what we're recommending, if we are recommending any change, is a new policy benchmark. So you can see for half a dozen of them, we are recommending a change to the policy benchmark. The fourth column, and this is a new concept, so I'll draw on it for a minute, is a secondary benchmark. And what does that mean? So for some asset classes, and particularly illiquid asset classes, and private equity and hedge funds are the two you see highlighted here, the benchmark that you're using for the long term, so let's look at private equity. You're investing in private equity with the idea of beating public equity over the long term. And measured over long-term time periods, 5, 10, 15, 20 years, that should definitely be your benchmark. Over short-term time periods, you're going to see significant deviations between the public equity benchmark and what your private equity portfolio does. A good example of this would have been 2008. 2008, public equities are down 40%. Even though private equity does mark things down, they don't necessarily mark the market. So in 2008, most private equity portfolios on average were down about 20%, so about half of the public markets. So there's kind of a disconnect in pricing. And then you saw a reversal of that 2009, 2010. So in the short term, you can see a disconnect that over the long term kind of works itself out. But if you want to measure how the portfolio is doing in the short term, a peer group tends to be a good way of doing that. So in these two cases, private equity and hedge funds, we're including a secondary benchmark. They're really more for looking at how are we doing in the short term. So let me walk you through each of the changes to the primary policy benchmarks. So the first one is for global equity. Currently, you're using what's known as the ACWI, the All Country World Index. So that is market cap weightings to US, Europe, Japan, emerging markets, et cetera. But you made a conscious decision to not use market cap weightings in your policy portfolio when you adopted the new targets in February. Most specifically, you voted to overweight emerging market equities. So if you had left the portfolio as it is, simply being overweight emerging market equities would have driven the difference in returns between your portfolio and the benchmark. So what we've recommended is adopting a policy benchmark that is weighted according to your target weights in US, Europe and Japan, and emerging markets. Still using the same sort of subcomponents. So you see it's hidden in the footnote there in very small text at the bottom. The three benchmarks are the MSCI USA, the MSCI World, and then MSCI Emerging Markets. Those three components, when added together, add back up to the ACWI. It's just weighted differently. It's weighted according to your policy benchmark now. The second proposed change is to the equity option strategies. Currently, you're using a publicly available buy right index. So this is an index that tracks the ability to write call options. And I don't want to get too too deep into the weeds here. Your current implementation of the equity option strategies allows for those two managers to do not just buy writing, but also put writing. And in fact, as of at least the last quarter, they've been doing more put writing than buy writing. Theoretically, the returns should even out over the long term, and it wouldn't matter, but there has been a difference historically. So we'd say, given that they have the opportunity to do both and that they actually engage in both, we think a mix of the two, the put writing and buy writing index, is more appropriate. Third one, and it's really third and fourth combined, the global asset allocation and other opportunistic strategies. And I appreciate when Jeff made us aware of his intent to really do this with the global asset allocation strategies, and we completely agreed with it. The idea of these managers and this group as a whole should be measured against what we would call sort of the opportunity set, the opportunity cost, really. The assets that are not invested in that portfolio essentially could be invested in the rest of your portfolio, but really only in the liquid parts of your portfolio. So what we're saying is we're going to use the total system benchmark excluding the illiquid parts, the private markets and the portable alpha. And this represents really, rather than just using a naive sort of 50-50 stock bond index, this represents the true opportunity set for you where your assets could otherwise be invested. Next is real estate. So part of this is just a technical change. The Odyssey is a peer group of core real estate funds, and historically been using the gross index, so gross of fees. You don't get to invest gross of fees. No one does. You invest net of fees, unfortunately. So we recommend changing it to a benchmark that is net of fees, the net of fees version compared to that. And because obviously the net is going to be a little bit of a higher hurdle, we also change, I'm sorry, it's going to be, in this sense, a lower hurdle. We change the value, say the hurdle over that benchmark up to 100 basis points. And we didn't just pull that out of the air. When we looked at where you are going to be going with this portfolio, probably a mix of about 60% core, 40% non-core. We expect the non-core to earn about 200 to 300 basis points over the core. You do the math, 40% of that works out to about 80 to 120 basis points. Midpoint of that is 100 basis points over the Odyssey.
Can I just
Please.
interject something? Historically, and I'm going back to 2009-10, when the real estate market was in a lot of disarray, Our approach at that point was to begin investing in real estate with the opportunistic, more high-octane type strategies. And recently, we've been, as the commission certainly knows, we've added some debt strategies, and we've been adding our core exposure, which is the more conservative flavor. So this is a portfolio that's been in transition and becoming more conservative and becoming more of a portfolio that you think of when you think of why have real estate in a pension portfolio. So we certainly, our returns have been phenomenal, and our team has done a great job in this regard. But we are moving late cycle, and this is certainly an initiative to try to take down that risk in our real estate portfolio. So this is intended to reflect that change as well.
What's your current thinking? Because I know it's, organizationally kind of been down and back on the mortgage credit, right? I mean, like there was some mortgage stuff in the mixed credit years ago. It came out because, as the mortgage funds came out. I mean, what's the thinking on?
Well, frankly, the real reason that I wanted that out of there was there was no good benchmark for it. So we were using a AAA. It was really just a duration benchmark. So we thought, we still have investments, structured credit, mortgage credit. We can still do that in some of our accounts, but we didn't want to be pulling down the performance of the bench. That just didn't feel right to me.
Yeah.
So getting rid of this AAA benchmark effectively was raising, and then it becomes the off benchmark decision that our managers can make to pursue those mortgage credits. Hasn't been as compelling as it, certainly 2009, 10, that was a fantastic time, and we deployed a lot of capital in that trade. But we haven't seen it be as compelling more recently, and I don't know if that's the flavor of the question, or do we think there's
it's really just
opportunity there?
I mean, you answered a little bit that you're trying to find a benchmark based on the basis of credit quality, not
Yeah.
duration, right? So like your high yield and your leverage loan would come in probably at an average of a double B,
Yeah.
right? And your private mortgage credit might be on either side of that,
Yeah.
kind of depending on what somebody's doing.
It's
I was just kinda
non-agency
curious.
or
Right.
agency,
Correct.
that's the
Like a
big fork in the road.
non-agency, but, you got different duration effects going on in a mortgage credit than you do a corporate credit, right?
Yep.
So I mean,
Yeah.
I get the difficulty,
Completely
but you
different
answered it.
sensitivity.
Essentially, you're
Yeah.
trying to build a benchmark across a credit
Yeah.
rating rather than duration.
Yeah, yeah, exactly. The goal of that mixed credit bucket was, our approach had always been non-investment grade. That was the path. We figured that the PIMCOs and BlackRocks, when there were agency mortgage-backed securities that were compelling, they'd be trafficking in that investment grade.
Yeah.
And this was really supposed to be more non-investment grade, which made the benchmark just kind of ill-fitting. And it's not that there was anything inappropriate about it. There was no good benchmark. That was our struggle. So we were trying to capture the essence of the mortgage-backed environment, but it wound up, we just saw it being more of a instrument of duration than anything else. And I wanted to see the performance of the policy benchmark increase. Yeah. Makes us be better, so.
The last change to the primary benchmarks would be for the portable alpha component, hedge funds. And it's currently using LIBOR, which is essentially cash, and switching to another measure of cash, T-bills, but now putting a premium over top of that. So part of the switch from LIBOR to T-bills is sort of longer-term thinking. LIBOR is actually going away in a few years. We're just kind of getting out ahead of that. The more nuanced component is that hurdle over cash. The idea is that if you are, anything you earn over cash is going to be, in the supportable alpha portfolio, is going to be additive or beneficial to your returns. And we'll talk more about this, I believe, at the June meeting, when we talk more about portable alpha. how much that premium should be, and here's again where we have a bit of combination
Can I
art
ask
and
a question about
science.
that? Should
Please.
you bump the premium there? Because LIBOR has a implicit credit component, and they're trying to replace it with the Fed kind of overnight thing. Should you bump the 250 by the same,
So,
to reflect?
yeah, we gave a lot of thought and discussion to the premium,
We had a little cage match over this.
to what this number should be. You know, and there are arguments for higher or lower numbers here. Number one, philosophically, how much risk you're taking on in that portable alpha program should be reflected in some way in that hurdle. So the more risk you have in that program, the higher that hurdle should be, the less risk, the lower that hurdle should be. Your program, and again, something we'll talk more about in June, is designed to be more conservative than a traditional hedge fund or hedge fund of funds program. With lower correlations to the rest of the market, lower beta, pardon me for the jargon, to the rest of the market. So how we eventually arrived at this number is we went back and looked at our capital markets expectations for various groups within the hedge fund. So we don't just have a hedge fund expectation, we have for different subcategories as well. We stripped out the stuff that's not in your portfolio. So you don't really do long short equity, for example, in your portable alpha program. And just looked at the remaining components. We said, okay, what are our capital markets expectations for those, if you weight those according to the way your program is weighted, over cash, and it worked out to pretty close to 250, I think it was 240 basis points. So after our cage match, we sort of agreed to a truce and decided that 250 was a reasonable premium to expect over cash over the long term.
The truth is Frank got his way. So, because he's the consultant.
So one thing, sort of a net effect, is a step back from it, and I think Dr. Wilder had asked me a question in advance about this. What impact do all these changes have to your benchmark? Well, the real estate change actually makes that one a little bit easier, that component of the benchmark a little bit easier, because the difference between the gross and the net can be as much as 100 basis points. So that one comes down a fair amount. But clearly, the portable alpha component, which has, you have as much essentially targeted to real estate as you have to portable alpha, 250 basis points more, that's clearly higher. The other sort of moving part, and this is the part we can't predict from year to year, is that change to the global equities. You change from essentially market cap weighting to an overweight to emerging markets, that's going to drive that difference in any given year. So we went back and looked at the last 3 fiscal years, and looking at for fiscal year 2015, this new benchmark would have been 20 basis points higher. For fiscal year 2016, it would have been 3 basis points higher. For fiscal year 17, it would have been 58 basis points higher.
You're talking just the equity part?
So I'm talking for the
all-
entire portfolio.
The whole slate of
The big
changes.
portfolio with that much of a difference. Averaged out over 3 years, 26 basis points, which is when we did sort of our back of the envelope math, we assumed it was about 25 basis point difference in being of a harder benchmark or net, a higher hurdle for staff to beat. Are there any other questions?
On the global equity benchmark, this is really for Jeff, probably. Do we actually have targets for the
For the components?
for the EU and the EEM components?
Yes. And those, so if you recall the last meeting, and apologies if I have I believe I had, no, I may not have it on me. We had one page with the kind of rolled up simple asset allocation. The following page had additional granular detail, and it's in that additional detail that is the guide for how we benchmark. So this married with those 2 pages would give you very clearly what that breakdown is, and then how it would be, how those benchmarks would be applied. So yes.
So this is jumping ahead a little bit. So, I mean, the net effect is it raises that policy hurdle for the staff.
Yes.
And, but, and this kind of ties back into, you know, what the treasurer used to always ask is the policy too low, right? Because when you look at it relative to the universe, you know, which Peggy asked questions about, it still looks very low. And I know in the past you said that was coming from 16 points of equity exposure was kind of driving that.
Yeah.
Right, so I mean, I think the benchmarks in and of themselves are fine, it's good that it raises it, but how much does that 25 basis point move that other issue? Does that make sense?
Yeah.
Right,
I mean, it's
because
year
like,
to year.
you know, the policy as it
Yep.
is in the Boney universe is showing up here,
Yep.
so we're gonna pull it up 25 basis points. How much does it pull it up?
Yeah, and it's, you know, this year, which is a bit different from some prior years, after only 8 months, that there's a wide berth this year between the median and bottom quartile. But, I mean, the answer is not an answer.
Yeah.
The variable that will determine this is whether U.S. equity performs appreciably better than other asset classes.
Right.
You know, if in a world in which the forecasted returns that we discussed last commission meeting, if we are in that world, this would be very significant. If we're in the world of the last 7 to 10 years, that's not going to be as meaningful. So I know that's not an answer that is terribly valuable, but the other way I would answer that is to kind of go back to there's a finite amount that you're going to do in benchmarking, and I'm always happy to refine our benchmarks in a way that sharpens our focus and raises the bar. But what we're really talking about is asset allocation. I defer to
So I would
our
agree, I think
colleagues.
that the bigger issue there is to track your peers, you need to create an asset allocation, not benchmarks, but an asset allocation that's more similar to peers. We don't advocate for that, and that's why we'd say you shouldn't get overly focused on the peers. But don't expect, so this raises the bar a bit, but if the asset allocation plays out that your asset allocation ends up being better for the next 10 years than peers, that's gonna drive you well above peers regardless of these benchmark changes. If your asset allocation turns out to be out of favor for the next 10 years, regardless of this, you could be well below peers. And that's what Jeff was saying, US equities, you have overweights to emerging and other things. If those end up being in favor for the next 10 years, that's really gonna drive the difference between yours and the peers.
Yeah. And to your point earlier, perhaps a more interesting stratification of this is find other plans like us that are looking at 7.25 as their hurdle and contemplate a custom universe. You know, to look at, and I'm a big fan of looking at what other plans are doing. I think there's great information in that. I do it regularly, so you know, I'd like to come back to you to kind of combine a lot of these questions into a single discussion. I think there's a lot of value in that.
Yeah.
And I think it's also important to note that, you know, when we look at the BNY Mellon universe and we look at our benchmark compared to the universe, what that's comparing it to is how does our policy benchmark perform relative to the actual return. It's not policy to policy, so we don't really have look through as to what the other policy performance is. Now, the one thing that we do know is CEM, when we get the CEM benchmarking report on a yearly basis, and it's off cycle because it's on a calendar year rather than a fiscal year, we still get more of our net return from the performance above the benchmark rather than the benchmark itself. So the raising the goal would be if we can raise the benchmark and keep the spread. Right now the actual performance of the benchmark is something that we need to spend some time thinking about. How do you look through and see how the benchmark actually performs relative to the peers as well? Because that doesn't give you necessarily the information.
Benchmark to benchmark, and then plan to plan.
Yeah, benchmark to benchmark and plan to plan, so that you're, that we know where we're, kind of where we fall a little bit more, I think specifically.
With the global equity, the new policy benchmark tracks how we do against, this overweighting to emerging market. But how do we go back and tell whether that was the right call to overweight emerging market? Did we go back and compare it just against the ACWI?
That would be an easy way to determine whether or not moving away from, I think that's a benchmark to benchmark question, the new global equity benchmark versus had we left it alone and just been market cap across the world, according to the ACWI Investable Market Index. I think that there's an easy, point of comparison to be made there, frankly. And Mike and I both, I think separately, we learned from David King that we've both done this. We like to ask questions about whether or not the changes we have made are effective.
Yes, that is
so-
good to know.
We just like to do that so we know where we stand. Wholly inappropriate to do that over an 8-month period of time, but I think as we get years,
Right.
then we start to be able to see whether or not there's value from having made some of the changes that we made. Some of them are very obvious. Adding equity in 2015 has absolutely been beneficial. There are, I highlighted the performance of REITs, not as beneficial, not beneficial at all, frankly, right now. So, but I think it'd be interesting to explore how to produce some of that for the commission's perspective.
I think that was an excellent question and comment. Would that be a reason to put some kind of global equity benchmark up there as a secondary benchmark? So we could routinely see whether our call in emerging markets or whatever other calls we make are proper, and it'd be routinely reported.
I think that's a good idea. Sort of the current policy benchmark becomes the secondary, so you see,
Right.
you're presented both.
Right.
Yeah, I think that's a good idea.
So we just move the current over to the secondary and.
Yeah. So you're seeing it both ways.
Yeah,
You know,
yes.
Here's what actually is, and then here's the last decision that was made.
Right.
And is that
Has it
working?
been productive? Yeah,
Yes.
I think that
You
makes
could
sense.
invest $1 and it went all around the world. What does that compare to the dollar that we're actually investing, right? So-
We consider that an amendment to this slide for the purpose of motion that's
Purpose of
coming.
the motion, I do think that would be
Yeah.
good.
You wanna-
So do we have more discussion on this, or are we,
I have one
Yes.
broad question, and this is just kind of being a new commissioner, making sure because I know I don't know everything. Other than the important use of using benchmarks as a important performance management tool, do benchmarks affect anything else? For instance, at one point, didn't they affect compensation? Some kind of compensation plan? So I'm just wondering if they have.
They still do.
They still
To
do?
the compensation
Yeah,
plan.
they still do.
Still has impact in that 6%. It's one of the three
Yeah.
hurdles. So it's 2% of the 6% of the merit in the compensation stuff. So it still flows
can-
through.
It still does?
I can dive in that with a
Sure,
little bit more
yeah.
detail if you want.
Yeah.
The, under the, the commission, for the investment staff, we used to have performance incentive compensation, PIC. And PIC was, the investment staff had a base salary, and then depending upon what level that they were in the organization, they could receive a percentage of that salary, which went from anywhere from 60 to 100%, based on how well the plan did versus the policy benchmark. And in essence, you got 2% of that eligibility for every percentage, for every BIP that the plan performed above the policy benchmark. So it was, at 50 BIPs, and you would get, if your compensation pick was, if your pick was 60%, you would get 100% of 60% if you got above 50 BIPs above. The one, then we've eliminated in performance incentive compensation. We're just now all all the staff across the organization are just paid a salary. As we really kind of looked at the incentive compensation, it's not that incentive compensation is necessarily a bad thing, and I think at some point in time we may revisit that issue. But I think we also have to think about what are the inputs to that formula. And when we thought about how do we create an incentive to like a merit increase pool, we put 3 factors into that rather than just beating the policy benchmark. So exceeding the policy benchmark by 50 basis points is still a factor, and that is 2%. Exceeding the performance of the median pension fund is another 2%. And exceeding the performance of the assumed rate of return is another 2%. So we've kind of added other components into how we award or how we create a merit-based pool. And then that's what Alan was talking about, like the chart that you see in the compensation policy. That's how that all kind of plays through. So we've added additional factors, which encourages us to not only outperform the policy benchmark, but gives us an incentive to make that foundational return better as well. So when there wasn't necessarily that connection between the two previously. So.
Thank you.
So, any other questions for Frank? If not, I do think we have a motion which covers both the ranges and the benchmarks. And I think we need to add an amendment to this regarding moving for any new recommended policy benchmark, move the old one to the secondary.
For purposes of global public equity.
Yeah. Oh, is it just for global public equity?
Yes.
Okay.
Right. Yes, ma'am. And would you want me to?
Yes, if you would like to read that, that'd be great.
The commission adopts a recommendation. The motion would be, Madam Chair, the commission adopts the recommendations of Makita and the CIO as amended to approve the benchmarks and ranges set forth on red number pages 71 to 72 of the open session agenda materials as presented, with the ranges to be effective as of April the 12th, 2018, and the benchmarks to be effective July 1st, 2018. Directs that the approved benchmarks and ranges be incorporated and made part of the SIOP, and authorizes staff to finalize the benchmark and asset allocation ranges by making any technical revisions or formatting edits consistent with the action taken by the commission.
So I think it was line number 70 is where it starts.
Okay.
It's not as number 2.
All right. Well,
Yes.
okay,
70,
sorry.
72.
70 to 72.
Okay. Would someone be willing to make that motion?
I move.
And do we have a second? Second. All right. Any further discussion on ranges or benchmarks? If not, all in favor? Aye. Any opposed? Okay. Ayes have it.
I'm going to let Mr. Woolley
Oh,
take the chair for the
excellent.
next.
Would you like to? Is anybody in need of a break?
Yeah.
Several people, yes. Let's plan to come back in 5 minutes, and that'll make it 10. So. Looks like everyone's back, so again, we will turn it back over to Makita. And actually, Peter will.
All right, thank you. Can everyone hear me okay?
Perfect. So,
Peter, we do have Reynolds on the phone, so I just want to, if you can make sure you're kind of.
bring the volume up.
Speaking
Okay.
up a little bit,
Reynolds,
so-
can you hear me okay?
I can.
Thank you. All right, so at the previous meeting, you may recall that we reviewed sequence of return analyses. We'll do a brief recap of that, but then share additional analyses that we were asked to perform that really, I think, are more practical because it then models in reductions in contributions once the fund gets to 100% funding status. So for the brief recap, I'm going to advance a few pages here to page 5 of 8, 79 in the full document. And recall that the sequence of returns is really how do you get to your 7.25 average return over 20 years. It can happen with strong returns in the first 10 years and weak returns in the second 10, or the opposite. And so recall that the sequence of returns doesn't matter at all to your end results if you're cash flow neutral. But since you have negative cash flows, sequence of returns can matter a great deal. So that if you have strong returns in the first 10 years and weaker returns in the second 10 years, but still get 7.25 over 20, the results are well above the projection. That's the red line up top. And that results in 123% funding over that at the end of 20 years, versus the light blue line in the bottom, which has weak returns in the first 10 years, strong returns in the second 10, and it produces results well below the baseline, and that results in 93% funding at the end of 20 years. So a pretty big difference. So the additional analyses on page 76, what we've done here is in the scenario, the strong early return sequence, the fund becomes fully funded after in year 8. So early on with strong returns, full funding is reached. So in year 9, we modeled a reduction in contributions. So in this hypothetical sequence of returns, the funding status continues. You see at year 8, it crosses the 100% line, but the funding status continues to move up because it has strong returns in that first 10 years. And so it peaks at 176%. So it continues to go up even though there's a reduction in contributions. But then with the second 10 years being the weak sequence of returns, it actually goes down, goes below 100%, goes below the baseline projection, and even goes below the bottom line where that was previously the lowest simulation, and drops down to 87% funding. So the middle line is the bright blue or the darker blue line. Here again, full funding is reached in year 17, and then you could see it flattens out at 100%. Contributions are reduced in year 17, but with consistent 7.25 returns, you maintain your full funding. So if there were only a 7.25 guaranteed return, it would be a nice smooth path. And then the bottom line with the strong late returns doesn't change because it never gets to 100% funding. There are never any changes to the contributions. And so,
Is that, excuse me, is that I guess, put it bluntly, a statement of fact, the middle line, if we make 7.25 every year, and based on the current statutory contribution rates, we're gonna be fully funded after 17 years? I know that's not gonna happen that way, but is that?
that's based on the actuarial projections, and that's, if you hit the exact actuarial projections for, things can change. Actuaries update their projections each year as well.
Yes,
The liabilities might change, the benefits might change. But if their projections for contributions and benefit payments were accurate and didn't change, and if you hit 7.25 exactly each year, not above in some years and below in others.
Yes, okay, thank you.
And there's just a big assumption, right? I mean, I've done big papers on the PBGC and everything, right? There's nothing behaviorally that encourages people to ever be fully funded, right? It's just a structural behavioral thing. So you're almost, what that means is you're always in deficit and at risk of drawdown in a
Yes.
pension plan. Always.
All right, any other questions on this?
No, I thank you for going back and doing that. But this struck me when you showed it to us last time. We continually look at that middle blue line, and that's how we think the system works. Is
Right.
that we get 7.25 every single year, and I would love it if we had a guaranteed 7.25%, because then we
Right.
really would be that way. And then occasionally we'll have some stochastic analyses which will show that nice blue line, but it'll show sort of like a cone that fans out around it that shows, well, these are all the other possible scenarios, but the expected return is still that nice blue line. And so it makes us, we draw our eyes back to, again, well, that's our, we have a stable return. And we really think, well, once we're 100% funded, we've made it. But so these two examples, you actually show two example return streams. I had not seen it that way before, but it really hit home to me that, okay, well, once we get 100% funded, we have not made it. And we can even go up to 100 and almost 180% funded. And I know at that point, we will think we have made it, but really, then only 5 years later, we're back down below 100%. So I think it needs to sort of instruct the way we look at return streams going forward. And if we, again, unless treasuries start yielding 7.25% again, this is the structure that we have, and we have to expect these huge upswings and huge downswings as part of the normal way that this runs, not just here, but retirees, active participants, the legislature, everybody has to realize this is the normal way that this operates. And so it just made me think that perhaps we need to start looking at it more like this on a regular basis, as opposed to just that very nice, stable blue line that hits 100% and then we've made it.
Yeah, I would actually point out two other things. Behaviorally, you're more encouraged to actually follow the light blue line, not the middle blue line. Right?
Yeah.
And then the other thing is what happens within those first 5 years, right? Because even on the path where it's overfunded, right, you see that sort of down swoop. And then on the bottom, you see kind of that J-curve effect. You got to make it to the long run, but most of that risk of which of those two paths you're actually on resides in your first 5 years. Right? So how you manage your cash during those 5 years is critically important, and how you manage that. Right, from a cash flow matching, because it changes how Jeff does his job.
Yes.
Right, but that first 5 years, I mean, you see how they both kink, right? One
Yep.
continues to go out before it mean reverts, and the other one, even though it's on a good trajectory, pops up, then falls back down, right? And you don't really know in that 5 years which period you're on, but you can,
Yep. Well, there will be a point in time along this sequence where the next experiences
Yeah.
start to look like that bottom line.
correct.
I don't know. Are there other, I don't really know how to look at this. I
Right.
mean, other than we've always looked at the steady, stable blue line. Are there other plans that look at this different way, or is this something, I'm curious what we can do to start, I guess, trying to adjust to this as being the normal.
Right, yeah, so it is something that we're encouraging more plans to look at, instead of just focusing on that one middle line, to recognize that it can be, even though after 20 years, you look back and say, we got 7.25, how come it doesn't feel that way? It's because it can have a big impact. A lot of plans are cash flow negative, so the sequence of return matters. So we're trying to elevate it to basically put it on people's radar that things, even if you get the number you were projecting, it's hard to plan, just for budgeting, and that you should just be aware that you can have significant volatility, that the sequence can affect it. We could look to continue to incorporate analyses like this on a regular basis, and continue to enhance those, to share them with you, because I think once you see it, you do realize, wow, we should be looking at this more regularly.
Right.
Madam Chair,
Yes.
these are two potential paths.
Yes.
And I would submit that, they're two of 10,000.
Yeah.
Right?
Right.
And I think we've looked at various points in time at the types of analyses that show you, the potential paths in 1,000, 10,000, whatever it is. I think that there's useful data in evaluating that, because it not only informs, the natural tendency here is to contemplate where are you at the end of the chart, right? And I think that you need to not only contemplate where you are, but contemplate where can the paths take you. And if you just to put this out there, I'm about to show you a chart that shows our risk relative to what we believe the median pension fund, or the average pension fund portfolio looks like. We believe we are taking less risk. So what are the implications for a chart like this, at not only at the end, but at points along the way, I think there's a usefulness to contemplating where different portfolio risks can take, what journey you're on potentially at the 25th percentile outcome, the 75th percentile. I think it's not only do you look at downside, but I think you do look at is there symmetry in this? And we have internally spent some time on this type of thing, and, I don't want to, I'm not going to put James on the spot because he's the architect of a lot of what we've been doing in this regard, by virtue of leading our risk team. But I think, perhaps there's an opportunity for us to bring some of that type of analysis just as for conceptual discussion with the commission.
Oh, no, yeah.
I think it would be, because I think when we think about kind of where the plan, and when we think about asset allocation, we're thinking about these types of decisions, if we're looking at it, with stochastically, and we're with with a lot of different scenarios that provide that cone of possibility. I think when we're thinking about how do various asset allocation decisions affect not only the direction, but also the shape of that cone, because we want to, I think, the goal is to have that go, up and to the right and be as narrow as possible, right? So that you have a little bit more confidence in what your potential outcomes are going to be when you think about that 25th to 75th percentile. So I think, we need to kind of maybe look a little bit more, spend some time looking a little bit more under the hood and see kind of how we think that this may go, because when we were looking at when we were doing the work for the joint committee and talking about, switching from one type, switching to a DC plan, I mean, there can be a lot of path dependency that once you kind of get some, if there's an outcome, there's path dependency, and you're not going to pull back out, And so I think we need to, the more we can think about it dynamically, because, I mean, volatility is expensive,
Right.
potentially. I mean,
Exactly.
yeah, I mean, because if you think about the chart that we've seen plenty of times where, back in 1995, you could have a portfolio of basically, an all fixed portfolio that gets you 7.25% and 6% vol. Now we've got our 13% vol, 13-point-something% vol portfolio, and it's going to get you, 7.25%, or 7.35 or whatever. And there's a lot of expense associated with that and the variability of your returns. Especially when you overlay cash flows and, some of your other assumptions. I think kind of looking at it that way can help inform some of our decisions, because I think we got to think about what does additional risk buy us, when we're, and how does it affect that dispersion of outcomes? Because I think there's as much risk in that dispersion of outcomes as there is in, having an asset allocation that may be perceived as underperforming or whatever. I think, we got to think about what are the cost benefits of that as we move forward. And I think that gives us a better way of looking at that.
Well, good, I'm glad that you guys are already looking into it. I would very much like to, or at the commission level, to sort of get updates on where you guys are with that, and maybe, work with Makita on any of their insights, or what other plans might be doing in terms of how are they reporting this and the sort of the stochastic nature of future return streams.
We'll take that as a directive.
Okay, excellent. Thank
Great.
you very much.
Oh, certainly, happy to do that. Should we move on to, let me see if it's
Let's
queued up.
see, what else do we have here?
Oh, I don't think that I
Oh,
think
it's not. I'm
supposed to
sorry,
be
you're
in
right.
the
It's-
research folder.
it is,
On Watch Docs, not in the materials.
And you told me that already, I forgot. So there was one other topic, if you'd like, I can cover that now. It was a follow-up topic on the estimated impact of the Tax Act on the retirement system. And so we can work to distribute and post these pages, as well as a newsletter that we've prepared on that. But what we have here is, maybe I'll summarize just some brief comments and open it to questions, but don't want to take too much time. I mean, I think some people could go on for a while about the impact of the Tax Act. there's a lot there, but I think first and foremost, I would say that we don't believe that changes in the tax policy warrant any significant change to the long-term strategic asset allocation to what you've adopted in February. We don't see any and don't have any recommendations for changes based on the Tax Act. That said, there are a lot of small nuances of that and how they'll play out. I'd categorize them in maybe three categories. Positive impacts. Their biggest one is global growth. And most economists, most estimates are talking about a positive impact on GDP over the next few years, potentially around 0.5% per year. And so that's clearly a positive. People talk about trade-offs related to it, but it's hard to argue that it's not going to create some stimulation and some positive impacts on GDP growth for the next few years. Likely, there's discussion about that fading over time as some of the tax provisions expire, or you have some of the some offsetting impacts of the early stimulus. That's the most positive, minor positive impact on private equity. But I think there's still a lot of work being done on, peeling back and understanding how it will impact there. But there can be new structures that will be created in private equity to try to benefit, to try to take full advantage of different tax structures and a number of other aspects. Some areas, if they're using a lot of debt, might be hurt in private equity, but the net impact, minor positive to the private equity industry and investments there. I'd say the next category would be things that are neutral: domestic equities, international equities. Both neutral. We don't see any significant impact on international equities, and on domestic, largely would say that most of that's priced into the markets already. I mean, that's where we saw the markets move so strongly in the fourth quarter, in December and in January. So most projections are that a lot of those benefits are priced into the market. Inflation is, we would say, in the neutral category. There's a potential for increased inflation, but inflation is low. The Fed's been struggling for years to target levels. This might help modestly, but most economists are not projecting that this is going to cause things to dramatically overshoot inflation targets. And then the last category I would say would be on the negative side, and three things to talk about there. One would be the U.S. dollar. So there could be upward pressure on the U.S. dollar. One reason there is significant profit repatriation from foreign profits brought back. That could cause upward pressure on the dollar from a retirement fund perspective. You have a lot of non-dollar assets, and so that would have a negative impact on a dollar rally there potentially. Fixed income would put in the negative category, a variety of headwinds that I think we'd see on the fixed income side. In high yield, you could have some limits on interest deductions. That could have impacts on future supply in the high yield market. But the biggest thing I think is rising interest rates. So a lot of your exposure to interest rate sensitive bonds will face challenges. We saw that in 2017. We're seeing that in the beginning of 2018 for sure. So possible increased inflation that could hurt, and certainly possible increases in interest rates. And then the other one that's related to that is debt level. So obviously this is going to create another $1.5 trillion in debt over 10 years. That will, so the deficits that we're talking about each year and the growing debt will create upward pressure on interest rates. And And that would certainly go in the negative category. But I think that would probably be balanced out in the later years, if you're looking at it from a 10-year perspective. I think they're looking at the net positives in the first few years, and some of these other things taking over and becoming more prominent in the later years. So once again, those are some of the nuances summarized here. We have a few pieces that we can share and make sure they're distributed. But I would just sum up also by saying nothing there would change any recommendations that we and staff have shared throughout last year and that you voted on at the February meeting.
You mentioned potential negative effect on interest rate sensitive bonds,
Right.
but probably a positive effect on something like TIPS.
It can. TIPS are impacted in a couple of ways. If it's just rising inflation and you're getting paid whatever the real yield is on the TIPS plus inflation, sure, those benefit or at least protect versus nominal bonds. But if real yields rise, that will negatively impact not just nominal bonds but TIPS as well. So there's some of those scenarios could help TIPS, some it still could hurt TIPS if real yields rise.
Okay, thank you.
Like right now, real yields, when TIPS first came out, or a couple of years after they came out, peaked at about 4 or 4.25%. So you were able to get 4.25 plus whatever inflation was. Pretty attractive. If you got 3% inflation, you get 4.25 plus 3, you'd get you 7.25. 100% backed by the Treasury. And over time, they've dropped down real yields to, depending on the duration of the TIP, down close to 0. And so you're basically getting 0 plus whatever inflation is, or for the longer duration TIPS, you're getting 0.25% or 0.5% plus inflation. If interest rates rise and that goes back up to 4, that'd be attractive to buy those after that happens. But for the ones that you hold right now, they're less valuable and they decline in value as if the market moves to higher real yields. Yeah. Any other questions on the Tax Act? All right, thank you.
Okay, thank you very much.
Where the clicker is? Peter, do you have it?
Yeah.
Thank you. Okay. Madam Chair, I'm going to be very brief. I thought it would be helpful for us to talk a little bit about the volatility in markets, and I will move swiftly through this, but please stop me if there's any question or anything that you'd like me to elaborate on. So I think it goes without saying that we've seen a substantial increase in the level of volatility in the equity market. It began at the end of January. The increase has been noteworthy, as you can see here. But let me give you what I find to be a particularly interesting statistic to help articulate this. Last calendar year, there were 251, apologies, I need to consult my notes. There were 251 trading days for the S&P 500. There were 8 days where it closed up or down 1%. So far this year, we've had 68 trading days, and we've had 28 days where the market has closed up or down more than 1%. So this is certainly a return of volatility into the marketplace. So what I'm showing you here is a 50-day rolling volatility measure, and we can see what's happening now is a departure from what has happened. But if we zoom out and look at it in the broader context, this is 90 years of data. You can see that way over here on the right, this is not something that we should regard as out of sorts for the normal course, the normal ebbing and flowing of volatility in markets. But it certainly is noteworthy, and we are paying very close attention to it. What I want you to observe here, what we're looking at, this is an index that shows you high yield spreads. And this is 5 years of data. And we pay attention to this, particularly during periods where the stock market is struggling, because You typically expect to see a beta in high yield to whatever is happening in the stock market and vice versa. But the spreads have not moved appreciably. And we think this is noteworthy because this is not what you would expect. You expect to see a more meaningful reaction if the market participants broadly felt that we had a real economic event occurring. Here I'm showing you the yield curve, and this is actually yesterday's yield curve is the top line, and the other line is the yield curve from exactly 5 years ago yesterday. And I find this particularly interesting and noteworthy because the 30-year yield, it has obviously moved during those 5 years, but it is at the exact same yield level that it was 5 years prior. But let me just point you to the tremendous flattening of the yield curve that's occurred by virtue of the Federal Reserve raising the front end of the rate spectrum. And this is transmitted through the front end of the curve and the belly of the curve much more effectively than it has been transmitted to the back end of the curve. And anytime you see a yield curve flattening, that is something that instinctively market participants get a little anxious about. This is the 1 year, 12-month Treasury. This is noteworthy because it has been a while since I've seen in 1 year. I'm using this as a proxy for our cash and short duration portfolio. This is 1 full percentage point higher over the course of the year. Some of these things are concerning, but I want to put this in the context of what's happening to the growth picture. This is a 2-year look at the forecast for this year's GDP growth. And what we're seeing here is even while rates have been rising, and perhaps this is the cover for the Fed to be normalizing the Fed funds rate, you've seen growth continue to increase. And this is something, we say internally, growth makes everything better. You can get to a higher rate environment if you have growth that can help sustain asset values, and we've certainly had that. There are challenges, some of which I mentioned, that I see for markets. Federal Reserve appears to be very motivated to continue to use this wave of higher growth to continue to raise and I think, as they would describe it, normalize the rate environment. I think we have to acknowledge higher rates by definition are going to reduce the appeal of risky assets. If you can make more without taking risk, you need to be compensated to take additional risk, and the mechanism for that to occur, frankly, is values to fall. A lot of the different markets that we are invested in are, by historical standards, you would regard them as expensive. That is something that adds to risk as well. The flattening yield curve I've addressed already. But I think there's something else that we need to be cognizant of, where we come out of an environment where we've had very low rates, very low vol in the market. That induced people who are not necessarily the natural equity investor, the yield hunters, come into the market. And if you have higher risk-free rates and you have higher volatility, this could create some panic, not panic, that's too strong of a word, create some discomfort for these investors, and you might see flows out of equities. This, I want to very quickly show you, is the slide I alluded to earlier. This is a trailing volatility measure that our risk team has put together, where it favors more recent measures or experience of volatility versus long ago experience. And you can see here the gray line is the portfolio that we believe represents the peer portfolio. want to be clear, there is no single peer portfolio. This is an amalgam of the data that we have that we turn into a portfolio. You see the 70/30 line is the orange line, and then our portfolio and the way that we are measuring our live volatility is the blue line. So I just wanted to, we discussed this last time. We've added the peer portfolio to this for awareness purposes. And then finally, before we move on, just to summarize, there are factors that I think are creating an elevation of risk. Balance that against the growth picture has really been quite favorable, and I think that that's keeping a lid right now on the potential downside in a lot of markets. I am not expecting that we go back to this low vol environment. I don't think we want to build a base case expecting, not unnaturally, but exceedingly low levels of volatility. And our job is to be a long-term investor. Frankly, when we see periods of elevated volatility, I view it as our job to look through that and to find an opportunity to make a long-term decision and exploit the opportunities that are presented to you by virtue of this shorter-term volatility. So I'm happy to answer any questions. I hope that was quick. I know the next agenda item is the AIP, but I'm happy to take any questions. Perhaps I've talked enough. So, Madam Chair, if you'd like, I'd be happy to move on to the discussion of the AIP.
Sounds great.
On March 17th, I provided an updated draft of the AIP to each of you. I want to thank you all very much for the conversations that we had about that document, as well as the feedback that you provided. It's very helpful for us to receive that feedback. It really is. If I can summarize for you, our goal here was to try to create a simpler, better organized document, and against that backdrop to clearly outline the initiatives. And we do have 34 different initiatives that we are including in this AIP. 28 of these are projects that are more investment focused, and the other 6 reflect goals of both our operations team as well as our legal team. One question that a few of you asked relating to this document as it was presented to you, and I apologize if I hadn't made this clear. We left out the tables that typically come at the end of the document, and the reason we left those out was because we knew we needed to have the conversation about the ranges as well as the benchmarks here. We'll obviously incorporate decisions made here into this document prior to posting it, but I apologize if I created any confusion in that regard. I do want to make sure that as you contemplate this document, I'm properly managing your expectations. 34 projects may seem ambitious. It in fact is ambitious. I'm very comfortable with that. I want to remind you, though, that several of these are projects that are not something that would fit within a year. Some of these are ongoing initiatives. Some of them are initiatives that we won't begin until later in the year and will be completed next year. And frankly, I want to also say some of these will be done before this document takes effect, probably. So I just want to make sure that that's clear. But let me pause here and ask if anyone has any questions about the initiatives, about any aspect of this, before we sort of submit it for a decision from the commission.
Can we talk about the rebalancing part? Because I do
Yes.
think that's an important
Yep.
initiative, but it was
Absolutely.
written as just, as what, intra-asset class versus inter-asset class? And this gets a little bit to Rebecca's question about even how would you measure emerging markets versus your benchmark and stuff like that, right? Because
and-
you can rebalance at both those
Yep.
levels, but the AIP only talks about looking at it
Sure.
from one perspective.
The intention was to include all of that.
Yeah.
So, and perhaps we need to do a technical amendment to that. It's certainly cross-asset class, but, you know, when you think about global equity, you know, we are always rebalancing, sometimes more dynamically and sometimes more structurally at month end. But what we really want to explore is we're doing it monthly, and are we disadvantaging ourselves by rebalancing too frequently? And then looking across different asset classes at the cost, you know, high yield has a different cost to rebalance than S&P 500 does. So, you know, we don't want to get into the situation where we're just reflexively rebalancing without giving a lot of thought to both the trends. I think some of you may have thought about this. If you're in a trending market, rebalancing is return reducing. Rebalancing is most useful when you have reversals. So, you know, we want to explore some of this, you know, measures that can help us be more thoughtful about rebalancing. We've gone to a really ultra-disciplined approach, and, you know, this is something that we need to challenge. So.
Jeff, I just have a question, to kind of confirm
Yes.
some of the conversation we had
Yes.
earlier. These initiatives, they're not a required part of this document, is that right?
Yes, that's
Okay.
correct. We're trying to, we approach it more from the spirit of what we think a plan should be.
Yeah, and no, I
Yeah,
think
yeah,
they're
to
great.
go beyond what is required, but-
Yeah, no, I want to see it.
Yeah.
I just add that as a lead-in to what I think the commission's responsibility is. You know, the statute says we need to monitor the AIP on a quarterly basis. So, you know, if we're putting all these 34 initiatives in here, even though we technically don't have to, I think as a commission, we need to figure out how we're going to monitor these and everything in the AIP.
Yeah.
You know, of course, we are adopting the SIOP too as part of it, but how are we going to monitor it? And I talked to Mike and Jeff some, and I think we might have an opportunity to talk about that maybe in June. But I just wanted to bring that up. I think that's something important.
Yeah.
Make all these documents useful for everybody, understandable, but also our statutory monitoring responsibilities. I think we ought to talk about that.
Sure.
Good point.
I think that's a good, and as we talked about,
Yeah.
just kind of, I think that's a good topic for us to think about for in June when we look to, you know, have a more strategic discussion as to how when we think kind of broadly about the, you know, the SIOP, the AIP, and then as we talked about, there's this other kind of statutory requirement that you give, that the commission gives Jeff. It's statement of investment objectives on a yearly basis, which aren't necessarily the statement of investment objectives and policies of the SIOP. So trying to figure out how all that fits together and a cadence to that, I think it would be a good discussion for us to have in June to make sure that, as you say, that everything is not only useful, but it also flows naturally in a way that we can kind of understand and that is productive rather than, you know, because I think we have to be, as we talked about, I think we got to be mindful of, you know, there's a statutory requirement that we have an annual investment plan, but we're also very long-term investors, you know, where we should be long-term investors we, in essence, right now have an infinite investment horizon. So how do you balance those? And so I think that's a very good strategic discussion for us to have in June.
And there are several forms that can take. By definition, some of these initiatives, the end point is bringing an investment to the commission or something like that. But there are others that perhaps aren't as easy for the commission to see, and I think I understand the question there, and we'll be trying to be thoughtful about how to introduce a couple of ways that we could
Okay.
service that need.
Thank you.
Any other questions for Jeff?
The use of the term static target, where we say we do not have static targets, yet we have ranges around everything. Do we have any static targets at all in our plan?
Yes, we have, the only place that you have targets that are not static are the private equity portfolio, which then creates a static, or a floating target for the public equity. The private credit creates a floating target for mixed credit, and then private real estate and the listed real estate. So the need for the non-static targets on the private side creates a corresponding floating target on the public side, but so that well, the way that we describe it is the combination of the two is a static target. The breakdown of the two is determined by the amount of the private expensive exposure that we have, so that we aren't compelled to just have that exposure without the appropriate level of conviction in the implementation. So, is that helpful?
Yes, it is. So the targets are static in other cases, even though there are ranges around them?
Yes,
Yes.
yes.
Other questions?
Just one, we talked about this a little bit when you called on the phone, about the, explore the utility of the multi-asset class passive index solution provider. I thought we had that in Russell. Do they not do certain asset classes, or looking to make a change, or?
We use them for the synthetic implementation of that. But if we, and this is something that I'm planning on having Brian address at the June meeting. We have Russell that can do these things synthetically for us. I'd like to have a physical provider as well. Russell can do some of this, but that is geared more toward transitional. Where we have temporarily, we don't have an active manager, so they get an interim assignment to manage to an index, or within some tracking error. What I'm thinking about is as we progress in our work on where to be active, where to be passive, we may have a longer term set of needs. And we do have 2 approved passive managers. And frankly, the question I'd like to put on the table is, could we, instead of having those be specific to a single index that they were approved for, could we have an approved slate of indexes that would give us an additional lever to manage the exposures of the plan?
It would seem natural you should do that for each of your benchmark areas, right, to the extent that you can.
Well, that's the rationale for this. So, if we've already underwritten, BlackRock is one of them. Certainly they have a menu of other exposures that we could gain passively, or because we only approved one index. I just like the breadth for how we could use these to have passive exposure, because sometimes the passive exposures can be considerable in size in the portfolio, and there are I do have the ability to make decisions to a point in between meetings, but I would certainly want this to be a discussion with the commission. So I'm not in any hurry to exercise that right. And there's no immediate need for this either.
Anything else? Okay. I do believe we have a motion. You would be interested in reading it again?
Certainly.
You're doing such
Yes.
a good job.
Yes,
with
Madam
that
Chair.
so far.
I'm glad I can do well at reading. The commission adopts the recommendation of the CIO and staff to approve the proposed annual investment plan for fiscal year 2018 as set forth in the red numbered documents beginning on page 93, with an effective date of July 1st, 2018, and authorize the staff to finalize the AIP by making any technical revisions or formatting edits consistent with the action taken by the commission.
Thank you very much. That was excellent. Would someone be willing to make that motion?
I move.
We have a motion, a second?
Second?
Second, okay. No, I think there's no further discussion, but if there is, feel free. But otherwise, all in favor? Aye. Any opposed? Okay.
Thank you.
Yes.
The next item on the agenda is, here we go, thank you. Is an investment that we have made pursuant to the delegation policy. And as a reminder, that's a policy that authorizes the chief investment officer to approve investment within certain limitations. That policy also includes a provision that calls for us to provide an update at the next scheduled commission meeting. And we're excited to share with you the first investment that we have made pursuant to this policy. And Derek Connor is going to walk you through a summary of the investment in just a moment, and we'll be happy to answer any questions that you have when he concludes. This is an attractive opportunity. We feel it's a private equity investment in a space that we call digital infrastructure. We think this is a compelling opportunity, not only because it's an attractive investment thesis at a macro level, but we came away really very much impressed with the leadership of the team at Digital Bridge. And I'm going to turn it over to Derek so he can articulate that in more detail.
All right, thank you, Jeff. So I'm here to talk about investment we closed recently in Digital Colony Partners, and we closed this investment on actually March 22nd for $125 million. And what this is a joint venture between two different firms. The first firm is Digital Bridge, which is a digital infrastructure investment manager that was established in 2013. And that firm was founded by Mark Gansey and Ben Jenkins, who have significant experience operating and investing in the asset class. And it's a combination with another firm called Colony Northstar, who's a very large and established real estate manager with about $46 billion of assets under management. And the way the partnership works is Digital Bridge will be primarily responsible for the investment function, and they get to access Colony Northstar's back office, compliance, and fundraising, which is pretty important, as you're establishing a first-time fund to have that back office support. So the strategy of Digital Colony will be to invest in macro cells, small cells, data centers, and fiber. These are the assets that transmit and store data. And one of the compelling things about this opportunity is if you look at the proliferation of data growth that we've seen over the last several years, there's a need to provide the infrastructure, to, like I said, transmit and harness this data. And this is the types of opportunities that Digital Colony will be pursuing. So in terms of how it fits into the private equity portfolio, you have digital infrastructure assets, and you have a private equity playbook. So we thought long and hard about, what's the appropriate asset class that it should go in. There are some infrastructure qualities, but there's also some private equity qualities. Ultimately, we decided on private equity, and that's in large part due to the return expectations. They're expecting to achieve approximately 15 to 20% gross IRRs, which is higher than you see in traditional infrastructure and more comparable to what you see in private equity. And these are very experienced partners that have experience building companies, and a big part of their strategy is called buy and build. So what they're doing is acquiring platform companies or starting platform companies, and over time scaling it through buying smaller companies and creating some scale, and applying more of a private equity playbook where they're increasing operational efficiencies, growing revenues, expanding to new markets, and that's something this team has a lot of experience with. And from a diversification standpoint, we do like the downside protection that we have through the assets. These are, typically very long-term contracts. If you look at macro cells, they could be anywhere from 20 to 25-year contracts. There's typically annual escalators to keep up with inflation. And if you think about, who's relying on these, for example, macro cell towers, think about the cellular network or cellular companies like Verizon and Sprint of the world. They depend, on the infrastructure, for their, cell phones. So, it's not like they're likely to, to cut it in the event of a recession. So we do like that downside protection. And there's, very solid cash flow generation that these assets provide. And if you think about infrastructure, typically there's a current yield component. As these assets are distributing cash, that cash gets distributed to investors. Digital Colony, it's a little bit different. As they're buying and scaling these businesses, instead of distributing most of the cash, they're putting it back into the business to grow it. And that's something that's very typical of private equity. And lastly, the correlation of these assets is very different than your typical private equity assets, which are much more correlated to public equity markets more broadly. These assets are more correlated to the growth in data and demand of data. So in terms of the rationale for the investment, there's a number of things that did, get us pretty excited about the opportunity. As I said earlier, there's been tremendous growth in data. If you look across the world, in most geographies, the demand for data is far outstripping the supply and the infrastructure that's available. So we think that demand growth is going to continue. And kind of an interesting statistic, if you take all of the digital data that's in existence today, 90% of that data has been created only over the last 2 years. So I think that's something that we expect to see continue. So taking the macro opportunity and then marrying that with what we consider to be the best-in-class team investing in digital infrastructure, with a significant amount of experience that they have acquiring these assets. Again, the team is led by Mark Gansey and Ben Jenkins. They have over 20 years of operating and investing experience. They have, a pretty deep team. As part of our diligence process, we spend a lot of time digging into reference calls. We called a number of other limited partners that have invested with DigitalBridge in the past, other general partners that have worked with them. We relied on the work of our consultant, Alborn, and spent a lot of time with the team and really getting comfortable with them in the next layer down. And, that was something that was really confirmatory for us.
Eric,
Yes.
I think you said earlier, this is a digital first fund,
Yes.
but they've got management has 20-plus years experience running these kinds of assets, I think.
Yep.
The assets in this fund, and with digital, I'm assuming they're always expanding. Are these new assets? They're going to put existing assets into the fund, or?
Yeah, so Digital Colony Partners, this is a first-time fund. Its predecessor was DigitalBridge, which was created in 2013. That firm owns 6 digital infrastructure assets, but it wasn't a commingled fund structure. So for each investment, they were going out to potential limited partners to raise capital for each deal. So this new fund, Digital Colony Partners, will be buying their own businesses for the fund. In some cases, they could be building businesses and, like I said, acquiring other companies to add on over time. So I'm not sure if that directly answers your question.
Yeah, that helps. So where's the source of their revenue? They lease these assets? They operate data centers?
Yeah,
Or
it
what
depends.
do they do?
So data centers, for example, there's a trend of, IT corporations more broadly outsourcing their IT infrastructure to data centers. You've seen tremendous growth. So what happens is Digital Colony, for example, they would buy a data center. They have all the equipment, the cooling equipment, where the IT, infrastructure would reside. And the corporations that are leasing the space have to pay rent over that. Typically it's over, anywhere from a 2-year to 10-year period. There's contracts. So Digital Colony would collect the rent that they're paying, and that's how they make their money. And over time, they'll try to build additional data centers or acquire additional data centers. So that's a big part of the strategy.
Thanks.
Yeah. And then lastly, the buy and build strategy. That's something that we do think is very attractive, and just the team's experience executing these types of transactions gives us a lot of comfort. Like any investment, there were some considerations that we had to get comfortable with. And we have one of the first ones that I mentioned was this is a first-time fund where DigitalBridge is coming together with Colony North Star and working together for the first time as a team. For a first-time fund, it is a large fund. They're targeting $3 billion. The hard cap is $4 billion. We fully expect that they're going to get there. And the reason it says $4.3 billion is because the general partner will be committing about $300 million of their own capital, so it'll likely be about $4.3 billion. One of the risk factors is the key man risk. Both Mark Gansey and Ben Jenkins, the co-founders, have played a very prominent role in the success of DigitalBridge over time. But as I said earlier, one of the things we got comfortable with is just the depth of the team that they have. And then lastly, there are potential conflicts that could arise with DigitalBridge, the predecessor company to Digital Colony. So again, we closed a commitment of $125 million to Digital Colony Partners. One of the things that we are contemplating and engaged with Digital Colony Partners on is establishing a co-invest sidecar vehicle whereby we could take on incremental exposure to Digital Colony portfolio companies with no fees and no carried interest. So that's something that's pretty attractive. We do have a seat on their investment advisory committee. This is something that we think is very important, potentially as conflicts could arise between DigitalBridge and Digital Colony Partners. The management fees are 1.35% over the 4-year investment period. After the investment period, the fees are calculated on the basis of invested capital. And since we were able to get into the first close, we do have a first close discount, and that works out to 15% of the management fee over the first year of investment, which would be about 1.15%. The preferred return is 8%, 20% carried interest, and the term of the fund is 10 years with up to 2 one-year extensions. So at this time, I'm happy to take any additional questions that folks may have.
Thank you, Derek.
Yep.
Good work.
And now we have
Executive session?
yes, and lunch is here as well.
Okay, so
So we could do
two, our next agenda item is to go to executive session, and then two, apparently we have lunch. So we could recede to executive session and then grab some lunch.
and then, probably eat while we're,
Eat, yes.
keep going, right.
Okay. All right, so is there a motion to recede to executive session to discuss investment matters pursuant to SC Code Sections 91680 and 916-320, to receive legal counsel, advice from legal counsel pursuant to SC Code Section 3470A2 related to litigation filed by American Timberlands Fund 2 LP, and receive legal advice from legal counsel pursuant to SC Code Section 3470A2. Okay, and a second, or we have two motions, so I think that should suffice. All in favor? Aye. Okay, we will move to executive session then.
point of executive session, I think the caveat would be that action was taken in executive session, and that action will be reported at such time that it would not harm or potentially affect the investment. So, that's the, and usually we have the language that we didn't take any action, but we did take action, so otherwise.
Thank you very
That's all.
much. I think that concludes all of our business, unless anyone has anything else. I'll take that as a no, but, so do we have a motion to adjourn?
So moved.
And I think we have a second, and all in favor? Aye, all right.
I think that's adjourned by consent.
Yes, all right.
Adjourned by mass exodus. Very good.